Most people getting into algorithmic trading right now don't actually understand the difference between prop firms and funded accounts that allow for algorithmic trading. And that misunderstanding is exactly why I'm making this video. Now, on the surface, both sound attractive. You're trading with other people's money, and you're using algorithms so you can supposedly scale faster. Under the hood, these are two completely different models built for two completely different types of people: traders versus investors. I'm Robert Miller, and over the past 5 years, I've been trading. I've done some manually, I've experimented with some prop firms, but really I've found myself transitioning fully into algorithmic trading structures that are independently verified and used by real investors today. And once you truly understand the difference, it becomes very clear why most people get stuck in prop firm challenges while others quietly compound real capital using algorithms. So in this video, I'm going to break down prop firms versus funded algorithmic trading accounts, what each is actually designed for, and which ones make sense if your goal is long-term scalable returns, not just passing another challenge. Now, what are prop firms actually designed for? Well, they're built around one core objective, and that is passing challenges and charging you for accounts. See, you're given a simulated or a heavily restricted account and asked to hit very specific targets that usually have very tight drawdown limits and fixed time windows. Now, here's the part that most people miss. See, some of these prop firms may say that they allow algorithmic trading to help you pass some of these challenges. But the truth is, the ones that help you do so, most of these were built for prop firms and just to pass the challenge, not designed to last. And so they're usually indicator-based, or they're short-term systems that are built to do three things: hit profit targets extremely fast, temporarily avoid drawdown rules, and optimize for passing, not longevity. Now, they're not designed to typically survive multiple market conditions. They're not designed to really compound, and they're really designed to get through a rule set once. And that's why you'll see people pass a challenge and then fail verification, or even get shut down weeks later because they can't actually use real algorithms that can scale. They're stuck with the ones that are typically provided. Now, you as a trader necessarily isn't doing anything wrong, and neither is the prop firm. It's just the system is designed to do exactly what it was built to do and nothing more. And so prop firms typically reward precision under constraint, not sustainability. And to be clear, if your goal is to game a rule set, extraction short-term payouts, and test ideas without your own capital, prop firms can make sense. But that goal is completely different than building a real algorithmic trading portfolio within your larger portfolio. And this brings me to my second point, which is that most prop firm traders never scale. See, this is the uncomfortable truth. They aren't really building real account equity over time. What prop firm traders typically do is restart challenges over and over and over and scale things out, and then hop from prop firm to prop firm to prop firm if they win, or even if they lose, or if the prop firm goes under. Now look, every reset means new rules, new fees, new standards, and a lot of times traders overlook this, is that it's new psychological pressure. So even when you're winning, you're still operating under forced conditions, forced position sizing, and even forced drawdown limits. And ultimately, even if you are succeeding, you have specific payout schedules. So the constant risk of account termination or not getting your funds is a big stress on most prop firm traders. And honestly, you don't really own the account. You don't control the capital, and you don't control the long-term strategy. And this is the key issue for real traders, because prop firm drawdowns are so tight, often 4% or less, it becomes nearly impossible to run strategies that actually grow accounts. Now, real trading strategies, and I'm talking to the traders that know this, experience drawdowns before expansion. So it's not uncommon to see a strategy sit in a 10, 15, or 20% drawdown before realizing a 20 to 30, even 40% gain. But when your max drawdown is capped at 4%, the entire class of strategy nearly becomes impossible to execute. So traders are then forced to over-optimize their entries, trade defensively, stare at screens all day to make sure it doesn't hit the stop loss, and manage rules instead of managing risks. And that environment constantly works against algorithms. See, algorithms need consistency, they need room to operate, and prop firm structures, quite frankly, remove both. And on top of that, even after passing everything, you're still waiting for payouts. Sometimes those are 14 days and sometimes those are 13 days. And we're now seeing a growing trend where prop firms shut down, payouts get delayed or denied, rules change mid-cycle, red flags appear after you've already invested the time and money. So even if you're doing everything right, choosing the wrong firm could mean your effort never really counted. And that's why most traders never scale. They're stuck proving themselves over and over again instead of compounding. So what is funded algorithmic trading? Well, funded algorithmic trading actually flips the entire script on itself. See, with a funded account that allows for algorithmic trading, there are no challenges, no profit targets that you need to hit. There's no artificial drawdowns designed for you to fail. Instead, you're deploying an algorithm into a funded account that's built to scale returns, not to test you. And this model exists for a few reasons. Now, if you're wondering, this sounds too good to be true, or why would this even exist? I'm going to break this down a few reasons as to why funded accounts are the biggest trend going into 2026. The first thing is that brokers are competing aggressively for users, and funded accounts are a powerful marketing acquisition tool. Now, the second reason is that investors for those brokers provide capital, and they can typically earn more through market activity and swap fees than letting their money sit in the bank in a CD earning a couple percent per year. And the third reason is that brokers earn fees and they want to earn fees on higher trading balances, so it's a win-win-win across the board. Now, here's how the structure usually works. You deposit capital and the broker provides a multiple. So that multiple might be 2x funded, 5x funded, or even 10x funded. So if you deposited $10,000, you might be trading with $20, $50, or even $100,000 in your balance for your actual trading account. And that amplification matters because when you tie an algorithm to the account, it's trading on the larger balance, not just your account equity. So it's important to understand the strategy that you're pairing with the funded account and how much drawdown is actually experienced. Because let's walk through this scenario. If you have a $100,000 account and the account is a 10x account, meaning you have $1 million in a total balance. If your account draws down by 5% in a trade, you will have the equity get impacted first. But on the flip side, if the trade goes up, you're sharing the gain. So here's how it works in an example. Let's say you have $100,000 in a account and they funded you 10x. So you're trading with $1 million. Let's say you just did a single trade and that trade went from $1 million down to $950,000, but then ultimately closed for a profit at $1,200,000. So that would be a 20% return on the balance, and on the drawdown, that would be a 5% drawdown from the $1 million. For your equity, you would experience a $50,000 drawdown or 50% of your account. And if you actually did a $200,000 profit, that would mean that your $100,000 grew to $300,000. And so you can see that a amplified account or a funded account, when paired with the right strategies, can actually help you partake in the upside without having to be limited to challenges, without having to be limited to specific drawdown metrics. It's ultimately up to you as the trader or the algorithm that you are pairing with this strategy to be compatible based off of its risk and based off of the amount of capital that you're actually trading with. So again, if the account draws down, your equity gets absorbed first. If the account grows, you're participating in a much larger profit base. There are no challenges, no hoops to jump through, and once profits are generated, withdrawals are typically available immediately, assuming that the broker is legitimate. So again, when you pair the right algorithm, these accounts are designed for real performance, not some sort of evaluation or some sort of quiz where they're trying to trip you up. But this also means that the strategy has to be built correctly. And so when you're choosing algorithms, you have to understand that the one that you choose has to be engineered for risk-adjusted performance. You have to understand the capital preservation settings with the technology, and you have to make sure that longevity across market conditions is something that's programmed into the algorithm. Because leverage amplifies everything, it isn't about optimizing for a pass rate, it's optimizing for a sustainable growth curve of your equity in your portfolio over time. Now, if this is resonating with you and you actually want to see how funded algorithmic trading works in practice, you can click the button below to book a time with me or my team. We'll cover how to evaluate the algorithms, why verification verification matters, how funded structures work without any challenges, and how investors are using this as a portion of their portfolio to enhance their returns. So if you want to learn more, go ahead and hit the link in the description and we'll talk soon. And that brings me down to my last point. Control is the difference between a prop firm account and a funded trading account that uses algorithms. Now, this is the biggest distinction that most people miss, because with a funded algorithmic trading account, you're not jumping through hoops, you're not asking for permission to withdraw a payout, and you're not restarting from zero every single time. You're running an algorithm that's designed to execute rules consistently, manage risk automatically, and allow capital to compound over time, and that way you can evaluate performance over months and quarters and even years, not within a couple days. So this model with the funded algorithmic trading is really designed for investors, business owners, professionals, and people who want exposure to algorithmic trading without living inside of the charts or challenges and don't want to risk a lot of capital overall. So if your goal is to enhance returns using a verified system and not gamble on passing another valuation, then this is the correct structure. Now, I want to be extremely clear on who each model is actually designed for. Prop firms are best for short-term traders, challenge-focused strategies, indicator-heavy systems, and people optimizing for payouts and for cash, not for their portfolios. Funded algorithmic trading is typically best for investors with capital who think long-term and people who value control, verification, scalability, and really trying to add more technology and uncorrelated assets to their existing portfolio. So it's not necessarily that one is better than the other, it's just that they are two very different paths. So that's the real difference between prop firms and funded algorithmic trading accounts. One is built to test you and the other is built to compound. So if you're serious about algorithmic trading and want to see real strategies, real verification, and how this all fits into a long-term portfolio, you can click the link below to book a call with my team. We'll walk you through the systems, the structure, and the results, so that way you can verify everything for yourself. And if this video is valuable to you, make sure that you're subscribed, because in the next videos, we'll be breaking down exactly how algorithms are built, evaluated, and scaled over time. So be sure to stay subscribed, and I'll see you in the next video.